Hello, everybody, and welcome to You Files podcast, Your Taxes Your Way. My name is Ida Chelly, and with me today, as usual, is my co-worker, Gerry Vitaratis. How are you, Gerry?
I'm good, Ida. How's it going?
Not bad, not bad. Finally getting closer to the end.
We're seeing the light now. It's actually visible at the end of the tunnel as we're recording this, right? Which I mean, it should
Correct.
when we're going to post it should be within the second week of April, right? So the lights at the end of the tunnel, as you can see, the bags are starting to get low. They're getting lower. See the progress right there. The
Gerry,
fatigue.
makeup. I keep telling you, you
You're
need to
right.
use it. It works.
I keep forgetting. I mean, we're TV stars now, right? We're YouTube stars, so we
No,
have
well,
to.
you are more than,
Uh,
come
Well,
on.
without you, I can't do this podcast, right? So there you go. We're both YouTube stars, So yes, I have to start taking care of myself right now for these podcasts.
All
But
right,
so what are
go
we going
on.
to talk about today? What's the
Today
topic?
it's going to
Whoa.
be the top family credits and benefits. So that's very important. We have a lot of families out there, and I
Mhm.
think there's a lot of good information in there.
Yes, absolutely. So it's related to a blog article that we're going to be posting on our website. We're going to post the link to in the description of this podcast. Whether you're just listening to us or whether you are watching us through YouTube, so whether you're listening to us through Apple Music or Google Podcast, or whether you are watching us through YouTube, we're going to post the link directly there. It's going to have all the details of everything we're going to discuss today. So which one
Okay,
we're going to start with
let's
first?
start off with the Canada Child Benefit.
Yeah, and that's the big one, right? So that's the
Correct.
big one for families in this case. So as long as you have a family with children that are less than 18 years old, the government will pay out a monthly benefit for every child that you have. There's a supplemental amount for every child that is less than 6 years old that you collect. The key to getting this benefit is that you must file a tax return every single year. It is the only way the government will pay that benefit, and the benefit gets renewed based on the information on your tax return every July, every year, essentially. So the payments are from July of the current year till June of the following year, and then the government will reassess at that point what your payment's going to be based on the tax return that you file on the previous tax return that you have filed. Now, of course, the benefit itself is income tested, meaning that the more income you make, the less you will collect. And then once you go above a certain threshold, you can no longer collect any benefit. Now, the threshold is quite high, I might add, but it is based on combined income, meaning that if you have a spouse, whether you are married or whether you are common law, then it's your combined income that the government will consider in order to pay you that benefit, which again is monthly.
And you brought up a very good point. You need to file a tax return. So even if one of the spouses has a nil income, the tax return needs to be filed, right?
Yes, because as I mentioned, the government will base the benefit on the your combined income, right? And the only way they'll know your combined income is if you file a tax return. So you really have to file a tax return in order and file it on time to make sure that you get the benefit on time. Because July will be the renewal of the benefit where the government will reassess based on your new information from your previous tax return. But the only way they can do that is if they have the return in hand. So the key is file on time, filed and you and your spouse should file as well. It's a perfect example that you gave, even if your spouse is not making any income. And we're going to talk about spousal amounts later on, which is another benefit, another credit in this case that we could claim as a family credit. Even if you have no income, your spouse should still file in order to make sure that they can collect the benefit on time.
All right, let's move on to the next topic, which would be childcare expenses and deduction.
Yes. So the childcare expenses is a deduction on your tax return on the federal side. For those of you who are listening to us in Quebec, it is actually a refundable credit on the Quebec side. Okay. But on the federal side, it is a deduction that you claim against your other income, just like you claim an RSP deduction, meaning that whatever expenses you incurred for childcare expenses, you deducted off the income you will be taxed on. So, for example, if you made $50,000 of income, your childcare expenses was $5,000. That means you'll be taxed on $45,000 instead of $50, because the government recognizes that you had that expense. You had that expense on your tax return for your childcare expenses. Now, how can you claim childcare expenses? What's the eligibility criteria? Well, the purpose of childcare expenses is to allow you to work. Okay, that's the purpose. All right. So you send your child to a daycare that allows you then to go and work. Okay, that's the purpose. So in other words, you have to have what the government considers as earned income in the year. That means that you have to have either employment income, self-employment income. Self-employment income in this case as well. It's got to be a positive self-employment income, meaning it can't be a loss in this case.
Mm-hmm.
Okay, because to the actual deduction that you're claiming is going to be the lesser of three amounts when you're computing the actual deduction. Okay, and the lesser of three amounts is going to be either the expense itself that you paid to the child care provider during the year. It's going to be a ceiling amount that the government sets per child based on the age of the child, okay? Or 2/3 of what the government calls your earned income, meaning again, employment, self-employment income. So of course, if you have a loss in your self-employment income, your 2/3 comes out to zero, and your lesser of the three amounts will be zero. At that point, you can't claim the deduction. Now, other criteria that is related to childcare expenses is that if you are a couple, if you have a spouse in this case, whether it is common law or you are married, it is the lower income spouse that can claim that childcare expense. Okay, it's only the spouse that has the lower net income that can claim those expenses, unless in this case the lower income spouse falls under what the government calls special situations. And the special situations can be, for example, the lower income spouse is in a post-secondary education, either part-time student or full-time student in a post-secondary education. The lower income spouse might be hospitalized for a certain portion of the year, okay, and other such exceptions. Okay, so if you meet one of those special situations, then you can share. You can share at that point a portion of the deduction with the higher income spouse. There's a proration calculation that's done on the formula, which UFile does, offhand. All you have to indicate, for example, to UFile is the number of weeks that the special situation is applicable. And at that point, there's going to be a split of the childcare expenses between the higher income spouse and the lower income spouse. But the basic rule is, if you don't meet one of those special situations, unfortunately, only the lower income spouse can claim the deduction.
Okay, and I believe day camp fall, for the summer, it falls in that category too, correct?
Yes, absolutely. So, for example, you would have a standard daycare, right? So a daycare which would be like, let's say, 7 in the morning till 6 in the afternoon, which would be a standard daycare that allows you to work. But if your child, for example, is of school age, for example, primary school or high school, and during the summer you need to say you need somebody to take care of your child, summer camps are eligible for those as well. And they don't have to be, for example, overnight camps either. Okay, it can also be summer camps where the child is, within the city, for example, within your municipality, and you go and pick up your child at the end of the day. Okay, those are eligible as well. Okay, so all these would be considered as childcare expenses as long as your child is less than 16 years old. Okay, and the moment your child goes 16 and above, then you can no longer claim unless the child is disabled. Okay, that's the only time you'll be able to claim if your child is 16 and above and is you have to send them to a daycare or a child care facility.
Okay, so let's compare the eligible dependent amount and the spousal amount.
Yes. So these are, there's a lot of myths out there where a lot of people think that they can actually claim both, right? In these things, but they're actually mutually exclusive. The moment you claim one, you can't claim the other. Okay. So let's start with spousal. So the spousal amount is where you are claiming, it's a credit, first of all, non-refundable tax credit, where you are claiming your spouse as a dependent, essentially. And what constitutes your spouse as a dependent? Well, it is their income. Okay, essentially, as long as their income is below the basic personal amount, which as of 2000 for the 2023 tax year is set at $15,000. If their income is below that, then you can claim them for the spousal amount. Okay, in this case, so the spousal amount credit is simply you take $15,000 less the net income of your spouse during the year. Whatever the net result is, you multiply it by 15%. That is your tax reduction, which is what we call the non-refundable tax credit, which is the spousal amount. Okay. Now, the eligible dependent amount is where you claim a child that is less than 18 years old as a dependent. But the catch is you can only claim the eligible dependent amount if you do not have a spouse. Okay, so you could see now how they're mutually exclusive, right? If I have a spouse, I can claim spousal, but I cannot claim eligible dependent, okay, because I am with spouse. Okay, to claim eligible dependent, I cannot be with the spouse. Okay, meaning that and I have a child that's less than 18, therefore I can't claim a spousal amount because I don't have a spouse. So they're both mutually exclusive. It's one or the other. Okay, so spousal amount or eligible dependent amount. In this case, eligible dependent, you can claim your child as long as they gained income of less than $15,000, which is the basic personal amount again, and it's the same calculation exactly as what I described with a spousal amount, meaning you take $15,000 less the net income of your child, whatever the net difference will be. At that point, you're claiming at a 15% credit rate. Okay, and of course, there's equivalents to these credits on the provincial side as well. So depending on the province that you're in, with the exception of Quebec, okay, if you are in any other province other than Quebec, there is an equivalent spousal and an equivalent eligible dependent credit on your provincial returns or the 428 forms. Okay, so there's an equivalent credit to those for those as well. So again, they're mutually exclusive. Now, the catch here is that in cases where you have, for example, let's say you separate in the year, or let's say you marry during the year, or you become common law during the year, the criteria for both of these credits is that you meet the criteria at some point in the year. Okay, and that's the key to those credits, which means that, for example, in the year where you become married, and let's say you bring a child with you from a previous relationship, you actually have the choice of which one you can claim. You can claim the spousal or you can claim the eligible dependent amount, but again, you can't claim both. Okay, so that's some other, particularities of those two credits.
All right. Let's go into the disabled child or spouse.
Yes. So for this one, I'm going to take my cheat sheet in front of me here because I'll need it because there's quite a few things that disability, the moment you become eligible for disability, can actually affect. Meaning that you can actually claim quite a few credits when it comes to the moment you are recognized with a disability. Okay, and that's the key here, is that it can't just be, for example, what the government calls an infirmity, meaning that you have an ailment, but it's not something that prevents you or really inhibits your day-to-day activities. And that's really what disability is that you have a condition where it inhibits your day-to-day activities. Okay, and that's the key. So now, the moment, whether it is your spouse, whether it is your child, or whether it is for yourself, okay, the moment you are eligible for the disability tax credit, meaning that a medical practitioner has certified on the prescribed form, which is the T2201, that you do have a disability, and the CRA has recognized your disability in this case, okay, then in that scenario, you can now, a bunch of credits and a bunch of benefits open up to you, okay, at that point. So just some examples of these, and again, I take my cheat sheet because there's so many, and within our blog article, you have the list right there. We provide you with a few of them. One of them is the disability tax credit itself, which is a non-refundable tax credit that you can claim, that your spouse can claim if they're eligible, that you can claim if you are eligible, or that you claim on behalf of your child. So if your child is eligible for disability tax credit, well then you make the claim, and then you can claim that their disability tax credit on your tax return, which the government calls disability tax credit transferred from a dependent, which means your dependent is claiming it, but since your dependent is likely not taxable on their return, well, they can take that excess amount that they don't need and claim it on, and you can claim it on your return. It's the same concept when it comes to your spouse. If your spouse is also eligible for disability tax credit and they don't need it to reduce their federal and provincial taxes to zero, again, you have equivalent credits on your provincial side, and this also includes Quebec in this case. Well, then you can claim the excess amount your spouse does not need on your own tax return. And a disability tax credit is quite a big amount. Okay, it can be quite substantive. And again, it's a non-refundable tax credit, meaning you're reducing your tax to zero with that credit. Now, another credit that opens up is the caregiver amount, or what the government calls the Canada caregiver amount. And this one essentially works in several ways. When it comes to your spouse or your dependent, okay, for example, take the spousal amount. Well, the spousal amount that I just mentioned before, where you take 15,000 less the net income of your spouse, and then you claim the difference as a spousal amount. Well, now the caregiver amount adds a supplement to that spousal amount. So instead of it being 15,000 minus the net income of your spouse, now it becomes almost 18,000 minus the net income of your spouse, which means you're increasing your credit base by at least about, I think it's around $2,500. Don't quote me on it, but it's around that level. Okay, it's about two. Yeah, it's actually 2.5 according to what I have here. Okay, so there's a supplemental amount. Now, the disability tax credit for a child, for example, you can claim the child even when they're over 18. And it's the same concept when it comes to eligible dependent. If you're a single family dwelling and you have a child that's less than 18 that is disabled, well, now again, you're adding a supplemental amount of $2,500 to the eligible dependent amount. Okay, now if you have other types of dependents, let's say an elderly parent, for example, okay, that is 18 and above, and is disabled, well, now you could actually claim a dedicated caregiver amount for that other type of dependent, not just your child. Okay, you could claim, for example, a parent, a brother, sister, et cetera, as long as they live with you. Okay, you can now claim that credit as well because the disability tax credit opens that up. Okay, it opens up the doors to the caregiver amount. Now, another benefit in this case that you can now claim, okay, you can now claim because of disability, because the eligibility of disability is the child disability benefit, which is a supplemental amount to the Canada Child Benefit that we mentioned earlier in this video. Okay, so you could claim, like I said, it's a monthly benefit that you could collect, which is the Canada Child Benefit, based on your income. Well, now, if the child has a recognized disability by the CRA, then you could actually claim now a supplemental amount to your monthly benefit, which the government calls the Canada Disability Benefit. Okay, and then another credit that opens up, and again, I'm just mentioning a few of them. There's actually quite a few more. Okay, but this is just some of the more popular ones, is the home accessibility tax credit or home accessibility expenses. Okay, where if you renovate your home to make it more accessible and amenable to somebody with a recognized disability, well, the renovation expenses now become eligible to be claimed for the home accessibility tax credit, okay? In this case, which is a non-refundable tax credit as well, which you claim at 15%. So you take the total of expenses up to a limit of 10,000, actually it's 20,000 now, excuse me. The government actually increased the limit, and you claim 15% of that amount as a tax reduction on your return. Here's the kicker as well. You could also double dip on those expenses as a medical expense as well. So if your dependent is disabled, whether it's your spouse or your child in this case, and they are disabled, then not only can you claim the home accessibility tax credit for these renovations, you could actually double dip and claim those same expenses under medical expenses as well. And the government literally allows this. They've written it in the law that you could actually double dip as long as you meet the disability tax credit. So you see here, the huge benefit of getting the disability recognized. If you are debating or doubting whether it's yourself, your spouse, or your child has some condition that could be recognized as a disability, there's no sense in waiting to get that disability recognized. Okay, go ahead and do it as quickly as possible. Go to your medical practitioner, have them complete the form, which is the T2201, which will provide a link in the blog article, okay, directly to it. Send it to the CRA, get it recognized, and then all these credits open up to you on top of the disability tax credit that I mentioned before. The kicker as well is the fact that you could even go retroactively. Okay, and claim all these credits if the disability has been recognized for several years. So if the medical practitioner signs off and says, you know what, your child has been disabled or your spouse has been disabled since 2020 or since 3 years ago, well, now you can actually amend your previous year's returns and claim, first of all, disability tax credit, and second of all these other credits that I just mentioned within this video, within this podcast. So don't wait. If you have a child or a spouse that you believe has that kind of condition that is really inhibiting their day-to-day activities, do not hesitate to go to your medical practitioner, fill in the form, and send it to the CRA as soon as possible.
Okay, so that's dependent on actually getting the certificate submitted to the government, correct?
Yes, so this has to be sent in advance, right? So in order for you to claim these credits, you have to get the CRA to recognize the disability, right? Which means that this form has to be mailed into the CRA. Unfortunately, we cannot transmit that form. It has to be mailed to the CRA, and then you have to wait for the response. All right. Now, usually with disability, I always tell people, hey, file electronically because it takes so long when you mail in the tax return. It takes so long from the CRA to answer. But in this case, for disability, they're actually pretty quick. Okay, they have a dedicated department. Okay, that where they receive these requests, and at that point they process them as quickly as possible because they realize it's substantive amount of tax savings that we're talking about here. Okay, and like I said, the retroactive too. You could actually go 10 years back. Okay, and retroactively make these claims. Now, you're talking about a substantial amount of money and substantial amount of tax savings that you could have. So really, do it as soon as possible. Go to your medical practitioner. They're used to, by the way, your medical practitioner is used to filling in these forms.
Mm-hmm.
Okay, most of them are actually trained to fill in those forms. So it should be pretty quick for them to fill in the form, collect it, mail it to the CRA within usually 2 to 4 weeks. They'll answer. Usually they will answer, and basically they'll give you a confirmation. Keep that confirmation. Okay, keep it just in case they refuse the claim, and then start making your claims and go retroactive and amend your returns, because now you have a recognized disability, which, like I said, is literally the key that opens the door to all these credits and benefits that are substantial tax savings for you and your family.
Okay, you're saying going back and claim the credits, it has to be as of when you're disabled. So if you were actually disabled like 2 years ago, you can go back 2 years. You cannot go back longer than that,
yeah,
correct?
Exactly. What I meant by 10 years is you have the possibility of going 10 years back, right? Because you could amend tax returns for 10 years. But yeah, your one of the first questions on the certificate form will be, okay, for how long has this condition been active? Okay, and your medical practitioner is going to mention, let's say, we're not right now 2024. So let's say it was 2022, right? Which means that now it means 22 and 23, you could retroactively make those claims, okay? And claim the benefits and the credits that I just mentioned on top of the fact that you claim the disability tax credit onto itself. Okay, so again, no brainer, do it as soon as possible, get it processed by the government, and at that point, submit your claims. And we're talking about substantive amount of money. Just a child disability benefit, okay, is absolutely is quite a nice supplemental amount to the Canada Child Benefit. So you don't want to wait. Collect the money that you are owed, because again, the CRA will recognize in this case the disability. But again, your medical practitioner has to fill in the form, and you have to mail it.
Great. Okay, so this covers the bigger points of the blog that you wrote recently. But in our blog, we also talk about the Registered Education Savings Plan, which you guys can take a look at, the transfer of tuition fees, and other credits like that. So I think we covered most of it here in the podcast, and we're up with time. So thank you very much, Gerry. Don't forget, everybody, deadline date is April 30th this year. And let's make sure we get those taxes done.
And just to review again, remember our website at what's called, first of all, on ufile.ca, we have our tax blog. Go to tips and tricks tab and just click on ufile blog. What we're mentioning here in this podcast is in there. We're going to provide you a link within the description. Also, on our website, we have a bunch of resources to help you out. On our YouTube page, we have a bunch of videos, a bunch of how-to videos on the software. We also have, more of these podcasts where we teach you about tax topics, various tax topics to help you to maximize your tax return. We also do educational videos as well on specific tax topics as well. We also have our Facebook page. Go ahead and like our Facebook page, because we do Q&As, live Q&As on our Facebook page. So go ahead and like our Facebook page in order to get the notification to our next Q&A, where I literally answer your tax I answer your tax questions live. You just write in the chat and we answer your tax question live. We're trying, and we offer this all for free. Okay, so So do not hesitate. Use the resources that we provide to all of you. We just want you to come. We just want you to come on our websites and try to maximize your tax returns using our
Yeah.
tools.
And if you follow our Facebook page, occasionally I will put the links to our YouTube channel, so for you to view the different videos we have on hand. And they're quite good, by the way, Gerry. You do a very good job at that. So thank you
Thank
very
you.
much for that.
Thank you.
So,
Even with no makeup, I'm not bad. It's all right. All
all
right.
right.
So I think
So
that
this
concludes it.
concludes it. Yes, it does. So thank you very much, everybody, for listening, and see you next time.
Thank you, everybody.